Welcome back to the monthly Alts Pulse. I'm Michael Sidgmore, co-founder and partner of Broadhaven Ventures and founder of the Alt Goes Mainstream podcast. Today, I'm joined by iCapital Chairman and CEO, Lawrence Calcano.
Michael?
Great to see you. I think we have a really interesting topic to discuss this week, and it's based on some recent developments in the wealth management space. So if you think about kind of one of the trends that seems to be a really big theme in the space right now, it's customization and differentiation. So Cerity, large wealth management firm, acquired Agility and OCIO. Hightower recently took a large stake in NEPC, another OCIO. I think that brings up a really interesting question of the context of where we are in private markets for the wealth channel. Because a while ago, it felt like it was just access. How do you get access? Now it feels like we're at the point of customization and differentiation. So I'd love to hear your thoughts on that.
Yeah, though I think for sure we're seeing that. The truth is the seeds of this have been in place for several years. For many years, RIAs have come to us and said, we're interested in this kind of exposure, or we like this kind of credit strategy or equity strategy or real estate strategy. What are you seeing? Can you build something for us? Apart from what might have been on our menu. And so we've been seeing that happen episodically for years. And what's happening now, particularly as these firms get much larger, is they want to really build bespoke programs for their advisors that really speak to customizing for what used to be 30, 40, 50, 100 advisors. That's now hundreds of advisors, if not larger. And they want to build something that really works for their entire advisor base. I think this is a very good trend because anything that really drives to really connecting to what advisors and clients specifically want is positive, right? Because you end up getting better fit between the products and the underlying clients. So I think it's a really good trend, and I think we're going to see more of it.
I want to hang on to something you said, better fit for clients. Are we now at the point in the entrance of the wealth channel into private markets where fit can actually be worked on and you can actually implement fit? Because first you had to get through infrastructure. Then you had to create customization. Are we at the point where that's now possible? And if so, what has made it possible?
I think so. I'll just step back for a second. And as I think about our business, I kind of see us really having gone through some important cycles, right, in terms of our evolution. And I think I share it because I think it reflects the industry's evolution. And if I go back a decade, really what we were focused on was access in an automated context, right? Too many people didn't even know where to go to think about getting access to alternative managers. And when they did, as we've talked about, the minimums were too high. So creating access to great managers in the right bite sizes was really critical, and giving them an automated platform to get that access. Phase one. Phase two was really expanding that access, expanding the functionality. In the case of iCapital, adding a much broader product mix. So hedge funds, all the different types of investor products, like accredited products in addition to QP products, mass affluent products, that brought in the whole registered space, direct exposures, direct investment, structured notes, et cetera. So broader product access, broader and more complete automation, phase two.
Mhm.
Phase three, we think about as creating an operating system for the industry to really build product that is unique to their specific needs, and where they can do that, where the process from beginning to end is all automated, including the data. That really is the oil, if you will, in the engine that makes this all work. And what we are seeing today is the innovation in alts, in the private markets, that really it tries to equate the private markets to the traditional asset strategies, right? We talked about model portfolios. People want to use models. Well, models is a way of customizing an exposure for a GP, for an advisor to get access to products for their clients. So models these customer bespoke funds that you've talked about, and you need tools to really be able to understand, if I build this, is that going to help my client get closer to or farther from their goals and objectives? And so I think the progress in technology is enabling advisors to create even better fits between products and their clients.
So on that point, if we think about now, advisors have access to all of this. Now, access is table stakes, not just to funds. That was phase one. But now they have access to tools to create more customized solutions for clients. How do advisors now differentiate?
Well, I think it's exactly on that. What I think people have sort of decided is, like, the pipes and plumbing, if you will, isn't necessarily a point where you can really differentiate yourself, right? And so I think it's been helpful certainly to us, but it's been helpful for people to say, that's not where we can make a difference in our overall client outcome. Where we can make a difference in our client outcome is making sure that they have access to the largest amount of product that is specifically and customizable, if you will, relevant to our clients. And that sort of quality of fit, I think, is a really important way in which an advisor differentiates. They understand the clients, they understand their needs and what the client understands, and therefore they can build product that really speaks to those client needs.
How do you think about customization and what that actually means when you think about the wealth market?
I think it just depends on the individual client. When for some clients looking for exposure to, you know, growth in technology, you don't necessarily have to build a special fund to express that if there's a great technology manager available that you can allocate to right there. So there needs to be a core amount of access. But for people who want to build either bespoke portfolios or who want to create, maybe it's a multi-manager vehicle, they want to build to some other exposure, they need the tools and the capability to be able to do that. So they need access to funds, they need access to diligence and information, which these OCIOs provide. And they need a technology infrastructure that allows them to build exactly what they want. And obviously, we're providing that to the marketplace.
I want to touch on the diligence aspect of this
Yeah.
because that's so important. A, in terms of just the continued evolution of this space from the wealth channel perspective. But B, it also seems like another trend where now firms, in some cases through evergreen structures, are enabling the wealth channel to get access to the same exact investments that their institutional LPs
Yeah.
have. So on that point around diligence, how do you think about the importance of diligence and the ability to actually help the wealth channel really understand, get that institutional quality diligence?
It's essential. I mean, the reality is, if you look at the private markets, the difference between the sort of top quartile manager and the fourth quartile manager in a private equity strategy could be 1,000 basis points. If you're not in the right managers, you are effectively in a different asset class. So diligence helps you understand that and understand how to select managers. And by the way, it's not just about what is the return. It's about what is the return, of course, but how do they generate that return, right? Because some managers generate return by really making investments in companies that they can help fundamentally improve, increase revenue, increase margin, et cetera. And when we think about diligence, we're always thinking about, how did the return get generated? How much of it was financial leverage, which is a commodity? How much of it was multiple expansion? How much of it was fundamental improvements in the underlying businesses? So the diligence process has to continue and is continuing to get more sophisticated as you think about these products. But it's extended because it's now not just, hey, here are some great products, as you were saying with respect to customization. Here are great products that we've diligenced that we think are managers who will continue to produce above average returns, and they fit into these portfolios, but maybe not those. So it's the diligence piece, but then the extension of that diligence is, if you will, the thoughtful placement of products in specific portfolios, but not necessarily all.
It's a really interesting juxtaposition here, making it possible for advisors to allocate in less steps and in more efficient and time and cost effective ways. Now, on the other side, it has to be thoughtfully constructed in terms of allocating to private markets, creating a portfolio, thinking about how everything fits together. How do you reconcile those two things in your mind, just from a conceptual perspective, but then also from the perspective of building a platform or operating system to serve the ecosystem?
One of the realities that we can't lose sight of here is that this business really starts and stops at the advisor's desktop. If an advisor doesn't understand these products, they should not show them. So you've got to educate the advisor before you even get to the client, right? You've got to make it easy for the client to present these opportunities to their clients, for the advisor to understand the portfolio context and the portfolio implications of adding these products. And so the process of the selection and the actual process, both those things have to be easy and thoughtful for advisors to really implement with their clients.
I think that's a really important and interesting point is that you talk to a lot of people in the space about the kind of advent of OCIOs coming into the wealth channel. And it's one thing to have those capabilities on the sourcing, diligence, and implementation side, but it's another thing to get advisors to actually understand them and also implement those products in a portfolio for clients. So those are two very different things.
Yeah, but I'll make one other point. As the world has changed, when you would allocate to private funds, that decision was a long-term decision, right? Now, we believe and are working on the creation of a secondary market like as exists with institutions, but it doesn't yet exist in a robust way for clients. So they're making a long-term decision, right? The evergreen products, they have certain liquidity features, which we've discussed. They're not liquid products, to be very clear, but they have certain liquidity features that do give the advisor and client a
Yeah.
chance to maybe sell, refinance
Rebalance.
it. So the implications of that is the diligence process doesn't end. So that requires an ongoing, not just reporting, because you always have to have great reporting, whether it's a QP, a private fund, or an evergreen fund, but your decision making, that it elongates, if you will, because you're continuing to make or have the ability to make decisions with these evergreens throughout the life of the holding.
On that point, what do you think are the most important tools that an advisor needs to be able to do that?
Well, they need information, right? They need high quality information that's available, that's accurate, that's timely. And they need to continue to be able to assess and evaluate the goodness of fit, as I was talking about, of a strategy in a portfolio. And so tools like Architect and other tools that the industry will certainly come up with provide the advisor a chance to continue to evaluate that quality of fit relative to clients' goals.
Do you think a lot of advisors want to spend the time figuring out what products they should enable their clients to invest in or have access to? Or do you think they'd rather have a plug and play solution like a model portfolio?
Look, I think all the advisors we work with, I believe, want to do the best thing for their clients. For some clients, a model portfolio might be a better way to invest, right? People invest in models in the current 60/40 strategies, if you will. So models can make real sense for a client based on their goals and objectives. For a lot of clients, the models will make a lot of sense. They might be multi-asset models, they might be growth-oriented models, more income relative to capital appreciation. They could be capital appreciation or growth models. The point is, it has to work sort of client by client, and having the tools, the ability to offer the QP products, the ability to offer evergreens, the ability to offer models, that's what advisors should want and have, which is lots of different ways to implement this exposure for their clients.
How do you think advisors will think about customization as a way to differentiate for their practice? And what does differentiation mean?
It's sort of what we've been saying. It's the differentiation or the way in which an advisor, can differentiate themselves to their clients is by having broad access to all the different types of strategies that might produce positive results for their clients. That might mean some of the large managers, it might mean some bespoke strategies, It certainly means having access to private equity, credit, real estate, infrastructure, hedge funds, structured notes. It certainly means having the broad strategy access, but it also, as I said, means access to different managers. That's a huge point of differentiation, the ability to get access to great managers and the ability to be thoughtful about how you suggest the client allocate and how you combine products. There's a lot of opportunities to combine products. There's going to be a lot of alchemy around how you combine products to produce the best possible outcome for your clients.
What's gonna be the key ingredient that makes some of those things that you just mentioned, constructing a portfolio possible? Is that technology? Is it just having access to the right managers?
It's all the above. I mean, it's technology for sure, in some way relates back to education, due diligence, understanding the difference between managers, understanding the client portfolios and how these assets fit into the portfolios. So education is really critical. It's still a newer asset class, generally speaking. So that's what will always be important, at least as far as I'm concerned. And then the product access and technology to be able to manage and process the business effectively.
On the point of education, is there something that is missing from the educational foundation for the wealth channel that people are not yet talking about now that we come into
Yeah.
this new phase of like there's a big focus on evergreens. There's now a lot of advisors who understand or know what private markets are, but then they need to understand the finer points.
I think it's just evolving. There weren't much in the way of evergreen products 2 years ago, 3 years ago. That's come on really strong. And even for advisors who are really well educated on these assets, thinking about the how you fund capital calls, for example, is a huge opportunity to improve the overall returns. And by the way, to make it perhaps even easier for the advisor. And then there's obviously a very large number of new advisors who are just coming into the asset class for whom education for them and for their clients is essential.
So it's an interesting time in this space because you think about where we are in terms of product innovation, like these evergreen products. There's now these hybrid products, public private products, Apollo State Street ETF as an example in the credit space, just as one
Yep.
example of what will be more, I'm sure. And Apollo's CEO Mark Rowan's talked about, what is private, what is public, as have many in the industry. Does that changing definition of what is private and what is public, how does that feature into this whole concept of customization? Will it be that everyone has a different definition of what is private, what is public, and that will then drive how they want to customize things?
Certainly, there are a lot of different definitions out there. It's actually just a natural and very positive evolution of this whole industry. Most firms 10 years ago were focused on institutions, right? Now it's great. The wealth community can now feel good that these managers, are focused on what they need that's distinct from what the institutions need. And they're building product. And the idea of combining public credit and private credit is another way to help advisors figure out how to build portfolios. There's a lot of things that people are going to try. Not all of them will work, but I think a lot of what's motivating this is exactly what should be motivating it, which is how do you find the best fit for client portfolios for the advisor to be able to implement for their clients. So this is like ongoing R&D, which I think is super exciting and positive for the industry.
That's a really important point that the GP side of the equation is really trying to figure this out because they know that they need to serve the wealth client and the wealth client may have different needs because the wealth channel is a spectrum of different types of clients. How do you think this concept and theme of customization will impact the GPs? And what I mean by that, to kind of go a layer deeper, is the larger GPs certainly will have the ability to work with wealth clients in a number of ways.
Yep.
Does this concept of customization help smaller GPs?
Anything that improves the opportunity for an investor to have a good outcome helps everybody, even if you're not an immediate beneficiary of it. And I've said this before, investors having success with these assets is good for everybody. It's great for the advisor, it's great for the GPs because it suggests that there's an opportunity for, these products to find successful homes in individual portfolios. That's a good thing. And I think you're going to see great innovation. There's, many Ares and Carlisle, and there's many great firms out there trying to figure out how do we build unique exposures for these clients in a way that will help them achieve their goals. And for other firms, firms like iCapital and others can really help them create those kinds of exposures that really allow their products to resonate.
When I think about this conversation, really the theme that threads through it is tension. So there's this interesting tension of, not in a bad way, it could be in a healthy way,
Yeah.
but access is now table stakes, customization is now the trend. You just mentioned something that I think is so fascinating when we think about the evolution of the alt space, which is the larger brands, the larger firms, they obviously want to figure out how to continue to work with the wealth channel. So what's the tension of brand and customization, access and customization, brand and customization? I think these are fascinating concepts to think about.
Yeah, look, brand always matters. And obviously there's a lot of things that go into brand, in this space. Returns is a really important start, but usability is an important part of the brand. How easy is it for advisors to work with you? How much time do you spend in their field? How is your reporting? Is it transparent? Is it clear? There's a lot of things that impact brand. And I think over time, again, with technology and education, more people have a chance to build a strong brand in this space. But it's very exciting. And as I said many times, like, successful outcomes for investors creates opportunities for everyone, not in a different order, right? If clients have great outcomes, that creates opportunities for everybody.
I think that's a great way to end and a really important way to kind of balance some of those tensions that we discussed. Again, healthy tensions. I think that shows 10 years ago, like you mentioned at the beginning of this episode, it was just about access. How do you give access to the wealth channel, to the biggest players in the space? We're well beyond that now. And I think that what you just said about focus on generating great returns, the infrastructure is enabling that to follow, everything else to follow from that, I think kind of encapsulates a lot of what's happening right now.
Yep.
Great conversation as always, Lawrence. Thanks. And thanks everyone for watching. I'm Michael Sidgmore. See you next time on the Monthly Alts Pulse.